Chad, it's going to be a busy and interesting session. So Alphabet is first up, reporting Q2 this afternoon. AI ad spending front and center. Obviously, they're no longer going after Wix. What's your trade here?
So we own this in our rising dividend, or actually our all-cap value portfolio, and I personally own it, and we would be buyers of it. Overall, it's got a reasonable price of valuation of 21 times 2025 numbers, 10% kind of revenue growth rate. It's attractively valued, high-quality properties regarding YouTube, as well as its position, we believe, exceptionally well when it comes to artificial intelligence and able to push that out to all of their broader applications. So we think they have a competitive advantage for the long run.
Okay, up next, Tesla also reporting Q2 results after the bell. The EV maker is lower by about 1.5% today. During the first quarter, Tesla reported its biggest revenue decline since 2012, but deliveries were actually better than feared for the second quarter. So, Chad, what do you think about this one?
So this is a valuation issue. Multiples of over 50 for 2025 when it comes to EBITDA multiples. We'd be somewhat more cautious on this. This is an auto company. The hope is that they can move up the application spectrum to higher profit margin businesses like robotaxi. But look, I mean, Waymo, which is owned by Google, already has an operating functional network that they're rolling out. So we believe that they may be somewhat behind their competitor at this inflection point. So we would be a hold at best.
Which competitor?
Waymo, that's their competitor, which is owned by Google.
You're right, exactly. That brings us back to Alphabet. Okay, let's move along to Visa then, Chad, which analysts are expecting the company to report higher Q3 results. But the shares are down 1% today. They're up 10% or so over the past year, kind of steady Eddie. What do you think about this one?
So this is the perfect steady Eddie. It's actually owned in our rising dividend portfolio. We've owned it for many years. We think it's attractively priced. The multiple has come down a bit over the last several years. We believe that still that transition from cash to debit and credit is happening. It's about 75% penetration here in the United States, which is mature, but it's nearly about 50% within the European Union. So we think that they have still a positive tailwind behind them over the next 3 to 5 years. It's a high margin business, 70% EBITDA margins, and we believe that they'll have top line growth of roughly about 10%.
And then if I'm kind of reading between the lines here, Chad, would you agree with Jeremy Bryan, who we were just speaking with, who says this is a rally that, inflation's coming down for good reasons, expansion can keep going, rally can keep going, and maybe the stocks that were left behind start to play catch up?
Yeah, my partner, Kevin Karan, just published a piece about this regarding that. The concentration of the large cap tech names was so out of whack with historic norms that you could see a broadening out overall, and that will give a positive tailwind to all stocks across the board, in particular high quality stocks.
Yeah, that makes sense. Chad, thanks so much. Appreciate it today. Chad Morgan.